What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner, and today is the live FOMC reaction. We have Powell and the FOMC meeting going to be deciding on their future policy. Are they going to hike? Are they going to pause, continue the pause? What is going to go on? I have been on vacation, so I haven't been live streaming over the last, I would say, week and a half. But I'm back now, and we just came back right in time for the FOMC. I will be doing a live stream tomorrow with Bitcoin Magazine, so make sure you tune in for that, 12:30 Eastern on the Bitcoin Magazine channels, and we will be dissecting all of this stuff with Powell, probably going into the press conference, see what he's saying there. This is just going to be a live reaction to the drop of the decision. Let me share my screen. This is bitcoinandmarkets.com, my home base for everything that I'm doing here. You can see I put out my podcast like show notes with all the charts that I talk about during these podcasts. And then I have Market Pro down here towards the bottom and my fundamentals report. I've skipped 2 weeks now on fundamentals report. That's very, it's not my MO to do that. I think in the 4 years I've been doing it, I've only skipped like maybe 3 other weeks, and I've skipped 2 in a row here, but I will be getting back to normal next week on Monday. So sign up there for free, and you can get the fundamentals report. Comes out every Monday, and then I walk through it on these live streams as well. But let's check the Bitcoin price here, because we'll get to see some reaction. Has been a sell-off as I have been gone this week. We have sold off. 50-day moving average is holding up the price, which is kind of nice to see, but it looks like there is just no juice or no fuel in the tank right now for Bitcoin. All right, let's take a look at the preview of the FOMC. This is from Zero Hedge FOMC preview, the last hike. For much of the last 18 months, there had been plenty of intrigue and anxiety over any single Fed announcement. Will they hike? Will it be 50 basis point, 25 basis point hike? Will the Fed be hawkish or dovish? Will it hint at more action in the future? Will Powell say, what will Powell say at the presser? Well, not this time. For better or worse, the market has decided the Fed will hike 25 bips tomorrow, and it will be it for the tightening cycle, which sooner or later will push the economy into contraction and presumably send inflation back to the Fed's 2% target. So yes, if you're new to my content, what I say is that the Fed just follows. Okay, the economy was inevitably going to go back into contraction. We had a huge supply shock with COVID. Then we had the first war in Europe in 80 years or so. I mean, I guess the Yugoslav war was in Europe, but it's the first major war with major powers in Europe, and we had all these sanctions that exacerbated the supply chain stuff. And so we had very high price increases. But that inevitably was going to be transitory and come back down. And that's what Powell said. I think that Powell still believes that, but he did this hiking cycle as a way to secure confidence in the Federal Reserve. So I do expect the Fed to raise 25 bips. This time, because they're not going to disappoint the market. There is a slight chance that they surprise the market. I know I saw the CME FedWatch tool. They were talking, or it said 0% chance of a just continued, to hold rates steady. But I believe there is maybe a 10 or 20% chance that they actually hold rates steady. Okay, let's go to this tab. We have 1 minute till the decision comes down. The Fed is widely expected on Wednesday to approve what would be the 11th interest rate increase since March of 2022, taking the benchmark borrowing rate to its highest level since early 2001. More pressing will be whether the FOMC officials feel they've gone far enough. Hiking more from here carries risks to an economy that many think is heading for at least a mild recession. And I do think that there's most likely going to be some mild recession in the next 12 months. We might be in and out of real GDP growth and, negative, positive, flip-flopping on the real GDP. But inflation, quote unquote inflation, CPI is coming down hardcore, and I expect that to continue. Okay, let's check the FOMC website. Should be dropping here. Let's refresh. Here we go. The decision has come out. Recent indicators suggest that economic activity has been expanding. Okay, this is the committee decided to raise the target range for the federal funds to 5.25 to 5.5%. So they did raise rates. They did not disappoint the market. We should see, the Fed follows. We had this discussion on Telegram earlier today, where does the Fed actually do anything, right? And I think the Fed is like a thermometer, that they will follow the market, and if the market crashes, they will cut drastically. They will slowly try to talk the market up. But if they were really in control and they really wanted to crash the market, they would have just gone to 5% immediately. Why go in 25, 50, 75 basis point jumps? Why not just go to 5%? That was one of my disagreements with Tom Luongo this whole time. Excuse me, because Tom Luongo had said, that we are going to, or that they want to crash the economy. They want to really stick it to Davos and all this stuff. And I think there is some of that. But if they really wanted to crash the economy, they would just go to 5% right away, or 10%. Why not 20? I mean, imagine if they took the Fed funds to 20% at the first meeting. That would definitely crash the economy. But or maybe it wouldn't. Maybe it wouldn't. And the fact is that their policy has no mechanical way of moving the market. It's all about jawboning, slowly shifting the narrative, convincing the market that this is going to tighten everything. I mean, they can't explain why there's a yield curve inversion. Remember, Alan Greenspan, the maestro, one of the most respected central bank chairman of the ever, and he said that it should be a series of 1-year forwards on these interest rates, that they could not explain why there was an interest rate or a curve inversion. They don't understand this. So they're just flying by the seat of their pants, trying to talk up the market, convince the market where they're going. And that's that. So let's read this. Actually, let's take a look at the markets and see what we got, if there's any reaction. Bitcoin, I'll go down to the 15-minute. See if we see any reaction. Not really anything to speak of here. I mean, it's a little bit green, but let's take a look at stock market. S&P 500, same, a little bit green, kind of a nothing burger here. Oil, same. US 10-year, big down candle. Let's go out to the daily chart on the US 10-year. And I still have these arrows on here from earlier. Going back here to July 10th and 11th, everybody was screaming about, oh my God, we're going back up higher on the 10-year. This means inflation is going to stay high and it's going to reaccelerate. Oh my God, look at all this. But no, this was just a back and forth. This is the pendulum, it got overextended this way. The market thought we could be breaking out to more growth, and it didn't. It just reversed. There is no growth here to speak of. There is no money printing to speak of. If you look at the bank lending, both on the standards side from the bank, the lending standards, and the demand from consumers, or from customers, I guess, there is no demand out there. There's very little lending. It's falling off of a cliff from both of those vantage points. So there is very little money printing. And in a credit-based system, if you don't have money printing, you have to have a rate of change that keeps things going. If you are printing money less than is being repaid, then you actually have a shrinking money supply. And people don't want to believe that. People want to think that QE is money printing, that fiscal borrowing is money printing. But this is That's not the way. The only way that you can print money today is through bank loans. Places like China, they know this because their stimulus is they just tell their banks to lend more money. But that doesn't work either because they will do wash lending. The banks will lend to each other back and forth to make it look like they're increasing credit and printing money, but they're really not. So there is no alternative to actual private sector healthy economic activity. Yes, you can have a temporary government boost, but that has to be from an existential threat. Okay, so like World War II, we spent a lot of money. There was an artificial stimulus from artificial central planning, and or I guess artificial economic activity. But that was a major threat. That was like an existential threat to the system, and um, we just don't have that today. They want to bill this stuff in Ukraine as an existential threat, but it's not. Okay, it's existential for Davos, for the global elites, for their ESG and their global Marxism plans. Yes, it's existential for them, but it's not for the actual economy because they are actually contrary to healthy economic activity. So it's we're not going to get um, we're not going to get like sustainable economic activity from artificial central planning spending. I hope that makes sense. I hope I'm making sense. I've been off for a week, guys. It's going to take me a minute to get back into this. But okay, let's go back to the FOMC statement and read through this. Recent indicators suggest that economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low, depending on what you're looking at. Inflation remains elevated. Now, also, I know that people listening probably are not new, but there are going to be a few new people each time that I do my live stream. So, just for those new people, inflation is the supply of money. That's why many of us say quote unquote inflation or so called inflation, whatever. And I try to always use inflation as money printing, not as prices. Prices go up and down for many, many reasons. One of them being that there is money printing. But since we've had QE, since the great financial crisis back in 2008, 2009, there has been low growth and low inflation, which is a sign of a disinflationary or a deflationary pressure on the economy. So we're in a giant credit bubble, and this credit bubble is popping. So this inflation remains elevated. What this means, in other words, is that money printing remains elevated, but we don't see that. We do not see that in the numbers. Money printing is not remaining elevated, and it never was elevated. It was a supply shock. Look, CPI is back under 3%. It's probably going to be under 2%, maybe down to 1 or 0 by the end of the year. You can take that to the bank. And so inflation, no. Money printing remains basically at zero, net money printing. All right. U.S. banking system is sound and resilient. Of course, we've had PacWest in the last 24 hours or so that is looking like it's crashing. So this is just narrative management, right? Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. Well, they have this backwards. Okay, they should be highly attentive to deflation risks. Deflation is always the boogeyman here for the Fed, for central banks. And many people don't agree with that because they think deflation is good. Sound money people will say, oh, deflation is good, but they are making the same mistake that inflationistas are making. They're deflationistas, maybe, but maybe I'm a deflationista. But no, inflationistas they call prices inflation. And people that say deflation is good, they are actually confusing prices with money supply contraction. Money supply contraction is not a good thing. I mean, that's why, like, one of the characteristics of gold, for sound money and all this stuff, is that all of the ounces of gold that has ever been mined is still around. Uh, it is very durable. One of the characteristics of money is durability. So, actual money supply contraction is not good. It's not a good thing. So, deflation is a boogeyman, just like inflation is. The deflation that these people are talking about is price declines. And prices decline because of efficiency gains, technology, supply chains, um, all sorts of things, economies of scale. And that's, yeah, sure, that's fine. But I don't think price declines, they are not good in and of themselves either. Uh, Maybe you could say that, like, food prices declines are good in and of themselves because people need to eat, right? But I don't know, because prices are information. And if prices are declining, most likely there's not going to be investment in those industries. There's not going to be, technology is not going to advance. There's all sorts of ways, rhymes and reasons, and ways the complexity of the market works, that price declines, even consistent, slow price declines, like people say, come from sound money. That's not necessarily a good thing either. You can't put a good or bad on these things, because um, maybe it's hiding something. Also, I mean, the stable prices that they say is part of the Fed's mandate, stable prices and maximum employment. You can get stable prices by just fixing the money supply, or sorry, fixing prices, with price controls. But that's not good. That keeps any information in the market from spreading. You want price fluctuations, people. You want both price increases and decreases. The thing is, you don't want price increases and decreases from a change in the money supply. That's why Bitcoin's fixed money supply is the best thing for money. It's the best type of supply condition for a money, is to have a fixed supply, not increasing or decreasing. This is why gold can never compete with Bitcoin, because they have a constant inflation of 2%. I mean, the Fed's target is 2%. That's also the gold industry's target. You didn't think of it like that, did you? The gold industry's target is 2% inflation, money printing, 2% more gold out of the ground every year. That is the goal of the gold industry, the same way as it's the goal of the Federal Reserve. All right, let's continue with this. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. Now, longer run, again, for those new, longer run means because they've always had this 2% target. It was an asymmetric target for a long time. So they would only intervene, quote unquote, intervene, if the inflation was over 2%. They didn't care if it was under 2%. That was okay with them, right? That's an asymmetric monetary policy. But then they started getting into, oh, we want symmetric 2% target. So that means if it's under 2%, we're going to intervene as well to try to get it up to 2%. And that just happened. That might have happened during Yellen, when they changed that type of rhetoric that they're talking about, a symmetric 2% inflation target. Now, Powell changed it to uh, average 2%. So they have an asymmetric average 2% target. This is getting a little crazy, right? If they're under 2% for a long time, they're going to intervene to get it up to 2%, but they will go over because if you average out a couple years of 1% and a couple years of 3%, you'll come out with a 2% average target. So you have this asymmetric average 2% inflation goal, quote unquote inflation, CPI, prices. All right. That's where we're at now. That's why they say in the longer run, on average over a period that's undefined, could be 5, 10 years, who knows, could be 2 years, whatever the case. But this is in the longer run, they have an asymmetric average 2% inflation target. So in support of these goals, the committee decided to raise the target range for the federal funds rate to 5.25 to 5.5%. The committee will continue to assess additional information and its implications for monetary policy. This is boilerplate. In determining the extent of additional policy firming that may be appropriate to return inflation or CPI to 2% over time, the committee will take into account the cumulative tightening of monetary policy. Okay, something just struck me here. Inflation. The way we know that it's not actually money printing is you can just count money, and you can say, "Hey, we're just going to increase the money supply by 2%." That's our goal. You don't have to try to do all of these fancy things to get prices. Like, you don't have to rely on core PCE deflator. That's their preferred metric for prices, is the PCE deflator. You don't have to rely on that, because prices are imperfect. Measuring prices is an imperfect science. Using prices to measure money printing is utterly ridiculous if you could just go and count the money. But they can't. And the fact that they're relying on these type of price metrics is because they don't know how to count the money. I mean, I don't know why that's hard for people that disagree with me. I don't know how that's hard for them to understand. M2 doesn't freaking matter. M2 is a narrow sliver, probably 1 to 5% of money supply. The rest of the money supply is in derivatives of derivatives. Assets versus liabilities on a bank's balance sheet. The health of a bank's balance sheet. So net credit creation. How much credit can we create next year that will service the previous debt that we created last year and all prior years that we're rolling over? We need to have net credit creation. Okay. But how do you measure that? They can only measure that by measuring what they see as the effects of money printing, which is price increases. But prices go up for a lot of reasons, like war in Europe, sanctions on the largest, one of the largest oil exporters or energy exporters, COVID shutting down the economy, trade war with China. All of these things cause prices to go up. It has nothing to do with credit creation. And as prices go up, they burden the economy more and limit economic activity, which will limit credit creation. We will get a net negative growth in credit, which is deflation, people. All right. The rest of this is going to be boilerplate. So they're taking into account cumulative tightening. They've said that for about, I think, 6 months now. They've said that this year. This is new language. Cumulative tightening is new language this year. The lags with which monetary policy affects economic activity and inflation, and the economic and financial developments. Now, this is interesting. The lags of monetary policy affects economic activity and inflation. Ask them what that is, and they will not know. You say, what is the lag? How long does it take? What is the extent? What is the property? What are the properties of this lag, and how do we observe it? And they cannot answer you because it doesn't exist, people. It exists in their mind. It's a correlation that they have created, or that they have used now to describe it, causation. Okay? To describe a causation. It's a correlation used to describe a causation. And it has a lag built in. So now they say there's a lag, but they cannot describe it. Okay. In addition, the committee will continue reducing its holdings of Treasury securities, so they will continue QT. Committed to 2%. Okay. All right. That's it, guys. So, like I said, Powell is doing his press conference going on at 2:30. I will not be live streaming it here, but perhaps I will cut out a bunch of those clips and talk about them tomorrow on FedWatch. Most likely that is what will happen. But anyway, I want to thank you guys for joining me. Check out bitcoinandmarkets.com. Join the Telegram t.me/Bitcoin and Markets. And support me on the website, bitcoinandmarkets.com. Help support this content, get more content like this. It's informative, educational, kind of fun. And we do have a community that is fun to be a part of, gives you a little bit of shelter from the crazy storm out there in Bitcoin, in quote unquote crypto, in macro, in culture, and all of these crazy events that we're witnessing today. So thank you guys for joining me, and I'll see you on the next one. Bye.